Hello, and welcome everybody back to Wealth Wisdom channel. Hope you're all experiencing a tremendous day. If you haven't already, make sure you're subscribed and following. This channel delivers you the genuine crypto intelligence before it reaches the mainstream. Today we witness something that at first glance appeared simple: a strong jobs report, a market rally, then a sudden reversal. But underneath that surface volatility, something far more significant is transpiring. BlackRock has quietly stepped deeper into decentralized finance. Ripple's CEO has publicly reaffirmed XRP as the core heartbeat of the company, and macro liquidity dynamics are beginning to tighten and loosen in ways that signal where capital may rotate next. When you zoom out, this isn't noise, this is structure forming. Let's begin with the macro backdrop. The latest Non-Farm Payrolls report significantly exceeded expectations. Markets were bracing for roughly 55,000 new jobs. Instead, we saw a print north of 130,000, accompanied by a lower than expected unemployment rate and upward revisions to prior data. On the surface, that's strong. It suggests resilience in the US labor market. It suggests demand is holding up. It suggests the economy is not rolling over. Initially, markets reacted exactly how you would expect. Equities popped, crypto caught a bid, XRP surged several percentage points within minutes of the release, and then something shifted. The rally stalled, sellers stepped in, the S&P rolled over, the Nasdaq followed, the Russell declined. Crypto mirrored the move almost perfectly. XRP retraced sharply, before stabilizing and attempting to recover. This synchronized reversal tells you something critical. This wasn't about XRP. This wasn't about crypto specifically. This was macro liquidity responding to cross currents. Strong jobs data can be a double-edged sword. Yes, it implies economic health, but it also implies the Federal Reserve may not feel urgency to cut rates. It keeps real yields elevated. It strengthens the dollar, and tighter financial conditions reduce speculative excess. Markets are forward-looking machines. They don't just price what is, they price what comes next. Add to that rising probabilities of political instability in Washington, including elevated concerns around government funding negotiations. Add geopolitical headlines and high-level diplomatic meetings that introduce uncertainty premiums into risk assets. You create a situation where liquidity becomes cautious. And when liquidity becomes cautious, volatility expands. XRP's movement during this window perfectly reflects that broader dynamic. It rallied roughly 3.5% on the initial data release, then retraced nearly 5% over the following hours before stabilizing again. That is not weakness. That is positioning being recalibrated in real time. Now here's where it becomes more interesting. While markets were digesting macro data, Ripple hosted its XRP Community Day, and during that event, Brad Garlinghouse delivered a message that many long-term holders have been waiting to hear clearly and unequivocally. He stated that XRP is the North Star for Ripple. Not a side project, not an afterthought, not a legacy token attached to a broader enterprise story. The North Star. He emphasized that Ripple Payments, Ripple Prime, Ripple Treasury, Custody Solutions, and the RLUSD stablecoin initiative are all strategically designed to increase utility, trust, liquidity, and velocity around XRP and the XRP ledger. That statement matters because one of the most persistent narratives circulating over the past year has been that Ripple might pivot entirely toward enterprise services while sidelining XRP itself. Garlinghouse directly countered that narrative. When you consider Ripple's valuation, estimated north of $60 billion in private markets, a substantial portion of that balance sheet is denominated in XRP holdings. The company's long-term strategic optionality is deeply intertwined with XRP's market structure and adoption. But the story doesn't stop there. Earlier in the day, Ripple announced a partnership with Aviva Investors to tokenize traditional fund structures on the XRP ledger. This marks one of the more significant European asset management collaborations in the real-world asset tokenization space. This is where the macro narrative intersects with blockchain infrastructure in a meaningful way. We are witnessing the early stages of capital markets digitization. Tokenization of real-world assets is not theoretical anymore. It is operational. Institutional asset managers are exploring blockchain rails, not for speculation, but for efficiency, faster settlement, lower costs, greater transparency, improved capital velocity. The XRP ledger's core value proposition has always centered on speed, low transaction costs, and scalability. When a traditional asset manager chooses that infrastructure for tokenization, it validates design architecture, and that validation compounds. Now layer onto that another development that sent shockwaves through the digital asset space. BlackRock launched its BODL tokenized US Treasury Fund on decentralized exchange infrastructure and signaled intentions to engage more directly with DeFi ecosystems. This is not trivial. BlackRock is the largest asset manager on the planet. When an institution of that scale experiments with decentralized rails for real-world asset exposure, it marks a structural shift in how traditional finance perceives blockchain. However, markets reacted in classic fashion. The associated token linked to that decentralized infrastructure spiked dramatically, roughly 40% in short order, before giving back much of those gains. This is textbook liquidity behavior. News-driven momentum attracts algorithmic flows, short sellers are squeezed, retail chases vertical price action, then early entrants distribute into strength. The more important takeaway is not the token's retracement, it's the signal embedded within BlackRock's action. The world's largest asset manager is integrating tokenized treasuries with decentralized finance rails. That's a bridge between traditional liquidity pools and blockchain-native infrastructure. And when bridges are built, capital follows. Now consider the broader ETF landscape. Goldman Sachs has reportedly added exposure to various crypto-related exchange-traded products on its balance sheet. That tells you institutions are not merely facilitating access for clients, they are allocating. Where does XRP fit into that? XRP sits uniquely positioned between payments infrastructure, liquidity provisioning, and real-world asset tokenization. It's not attempting to be a generalized smart contract casino. It's positioning itself as financial plumbing. And financial plumbing does not need hype cycles. It needs integration. Let's step back and connect these threads. Strong labor data keeps monetary policy cautious. Policy caution tightens liquidity, marginally. Tight liquidity compresses speculative froth. But underneath that surface volatility, institutions are building. Ripple expands tokenization partnerships. BlackRock experiments with DeFi rails. Major banks allocate exposure. Regulatory clarity inches forward. This is not a top-of-cycle narrative. It feels much more like mid-cycle consolidation before a structural breakout. Short-term volatility remains elevated. We still have CPI data ahead. We have initial jobless claims. We have ongoing political uncertainty. Each data print recalibrates rate expectations, which recalibrate dollar strength, which recalibrate risk appetite. Expect sharp moves in both directions. But volatility inside an adoption cycle is not bearish. It is necessary. Markets climb walls of worry. They do not rise in straight lines. Crypto remains a liquidity-sensitive asset class. When real yields rise, capital rotates into safer instruments. When yields compress and dollar strength weakens, digital assets expand. The key variable is global liquidity. If central banks begin signaling accommodation later this year, the second derivative of liquidity turns positive. That's when beta assets, including XRP, tend to outperform. And if tokenization narratives continue to mature simultaneously, you create both cyclical and structural tailwinds. That combination is powerful. XRP's recent price action rally, retrace, stabilize, reflects macro tension, not fundamental deterioration. And when fundamentals are improving beneath the surface while price consolidates, That is typically accumulation territory for patient capital. Garlinghouse's statement that XRP is the North Star is not just rhetorical reassurance. It signals capital allocation priorities inside Ripple's ecosystem. Every product vertical he mentioned, payments, prime brokerage services, treasury management, custody, stablecoin issuance, creates transaction flows, and transaction flows create liquidity demand. Liquidity demand increases utility. Utility reduces speculative dependency. That's the maturation arc of any digital asset that survives long enough to integrate into financial infrastructure. The partnership with Aviva Investors strengthens that thesis. Tokenizing traditional fund structures means bringing regulated, institutional-grade assets onto blockchain rails. That introduces compliant capital pools. Compliant capital pools are sticky. They do not rotate based on social media sentiment. They rotate based on yield spreads, counterparty risk, and operational efficiency. If the XRP ledger becomes a preferred settlement layer for tokenized funds, it anchors long-term transactional relevance. That's different from narrative-driven token appreciation. It's infrastructure-based valuation. Tokenized US Treasuries have grown significantly over the past year. Asset managers recognize that blockchain settlement reduces friction and enhances transparency. BlackRock's BNULD initiative confirms that the largest players are not waiting on the sidelines. When traditional finance integrates blockchain for treasury exposure, they are effectively validating the architecture. And once validation occurs at scale, regulatory clarity tends to follow. The crypto industry has operated under regulatory ambiguity for years, but the tone has gradually shifted. There is increasing recognition that tokenization is not inherently speculative. It is an efficiency upgrade. If policymakers differentiate between speculative excess and infrastructure innovation, platforms like the XRP ledger stand to benefit. Because XRP's core use case has always revolved around cross-border settlement and liquidity provisioning, areas that regulators actually want modernized. Short-term outlook remains tactical. We have CPI data ahead. Inflation surprises in either direction could trigger sharp repricing of rate expectations. Watch bond markets more closely than crypto charts. If treasury yields break lower decisively, that's your signal that liquidity is easing. Long-term outlook is where conviction deepens. Tokenization is not a trend, it is a transition. Just as electronic trading replaced open outcry pits, blockchain settlement may gradually replace legacy clearing infrastructure. XRP's role within that narrative depends on execution. If Ripple continues expanding institutional partnerships, integrating liquidity solutions, and positioning XRP at the center of product architecture, then network effects accumulate. Network effects are exponential. The volatility you're seeing today, 3% up, 5% down, 2% recovery, is noise relative to decade-long adoption curves. The question is not whether volatility persists. It will. The question is whether infrastructure continues integrating. So far, evidence suggests it is. Strong jobs data triggered volatility. Political uncertainty amplified it. Algorithms exaggerated it. But beneath that surface turbulence, institutions deepened engagement with blockchain rails. Ripple reaffirmed XRP's centrality. Asset managers tokenized funds. BlackRock bridged treasuries into DeFi. That's not a topping process. That's foundation laying. Liquidity cycles will ebb and flow. CPI prints will surprise. Headlines will shock. Prices will swing. But infrastructure quietly compounds. And when liquidity expansion eventually aligns with institutional integration, the repricing can be swift. Patience in accumulation phases is rarely comfortable, but historically it's been rewarded. If you found value in today's breakdown, don't forget to like the video and subscribe. This is Millionaire Finance, and I'll see you in the next one.